Welcome to The Explainer. Today, we're going to pull back the curtain on something that, for a lot of people, feels like a mix between a lottery ticket and some secret Wall Street handshake, the IPO. But what if you could swap that gamble for a solid game plan? Well, that's exactly what we're going to build together right now.
So let's be honest. When you hear the word IPO, what's the first thing that pops into your head? For a lot of us, it's pure chance, right? A high-stakes bet, hoping for that one massive payday. But is that really the whole picture? Or is there a way to look at this as a genuine golden opportunity?
Well, here's the thing that pros know. They don't see it as a gamble at all. They don't play games of chance. They operate with a very clear, very repeatable system. And today, we're going to crack that exact system wide open for you. All right, let's dive right in. Our first step is to completely reframe this. We're going to take what feels like a game of chance and turn it into a game of skill. And it all starts with one core strategy. And that strategy is called IPO arbitrage. Now, it sounds a little fancy, I know, but the idea behind it is actually pretty simple. It's all about finding and taking advantage of these little pricing glitches or gaps that almost always pop up when a company goes from being private to being listed on a public stock exchange. Right there, in that inefficiency, that's where the real opportunity is hiding. So, spotting those opportunities. Well, it all begins with decoding the price. Let's dig into how the pros figure out if an IPO's price is right long before they even think about putting a single dollar down. You know, the whole pricing magic really hinges on this thing called book building. The best way to think about it is like a silent auction. But it's an auction that's happening behind the scenes, mainly for the big institutional players. The company's basically feeling out how much these big guys are willing to pay to find that perfect price. If you understand how this auction works, you're already one step ahead. Now, to play the game, you gotta know the players. And look at this. The shares aren't just thrown into one big pot. Half the pie, literally 50%, is set aside for what they call qualified institutional buyers, or QIBs. Think big mutual funds, pension funds. Then 35% is for retail investors. That's probably you and me. And the last 15% is for non-institutional investors, which are basically individuals who want to invest larger amounts. Knowing you're in different playing fields is absolutely key. So, how do the pros make the call? It's not a gut feeling, it's a checklist. They're asking sharp questions. 1. How does this company's valuation look next to its publicly traded competitors? 2. Is its growth story strong enough to justify paying a premium? 3. Is the overall market climate right for an IPO right now? And 4. Is the whole industry, the whole sector, on an upward trend? It's this disciplined, multi-layered analysis that separates the pros from the amateurs. Okay, so once you've done your homework and you feel good about the price, it's time to actually apply. But here's the kicker. Success isn't just about deciding if you should apply, it's all about how you apply. A smart strategy means you've got to choose your battles, because not all IPOs are the same. You could go for a stable, quality, large-cap company. That's a lower risk play for more modest, steady gains. Or you could aim for a smaller, niche company. Now that's much higher risk, for sure, but the potential upside is also way bigger. The trick is to know your own comfort level with risk and pick the category that fits you. And here's where we get really tactical. This is a huge pro tip. To really boost your chances of getting an allotment, you don't just apply once. A seasoned investor might apply through the regular retail category, but also in the NII category if they have the capital. They'll even use applications in the names of different family members, or in places like India, they might use a legal structure like a Hindu undivided family, or HUF, to get access to another separate quota. See the pattern? You're using every single legal channel available to stack the odds in your favor. Okay, you did the research, you applied like a pro, and you got the shares. Now comes the most intense part of the whole process. Listing day. Let's talk about how to master this high-stakes moment when that opening bell rings.
That first hour of trading is absolutely critical. And you're basically looking for one of two stories to unfold. On one hand, you might see an opening spike. It's like a firework. A huge burst of excitement, and then poof, people start taking profits and it fizzles. On the other hand, you might see a gradual rise, which is a much better sign. It suggests the big institutions are steadily buying in, showing real confidence. Reading that pattern tells you everything about the market's mood.
And I can't stress this enough. You need an exit plan based on these signals before the market even opens. For instance, your rule might be if the stock jumps over 50%, you sell a part of your holdings to lock in those gains. No questions asked. If it's a solid but less spectacular 20–50% gain, maybe your plan is to hold for a week or two. And if it opens below what you paid, it's not time to panic. It's time to go back to the drawing board and reevaluate the company's core strengths. The goal is simple. Act on your plan, not on your emotions.
But hey, the game is far from over on day one. Now we get into the long game. This is about what to watch for once all that initial excitement and hype starts to fade away. There is one date that every single IPO investor needs to circle on their calendar in bright red ink. It's the lockup expiry day. This is the moment when all the insiders, the founders, the early employees, the venture capitalists are finally allowed to sell their shares on the open market. And that potential flood of new shares can, and often does, create a ton of volatility.
But here's the thing. A smart investor sees this not just as a risk, but as a scheduled event you can build a strategy around. A month before it happens, you're analyzing who might sell. On the expiry day itself, you're watching the trading volume like a hawk. And then, in the weeks after, you're looking for buying opportunities once all that selling pressure has eased up and the stock starts to find its new stable price. In all of this, all these strategies and timelines, it brings us to our final and maybe most important section. You can have the best system in the entire world, but it means absolutely nothing without the right mindset. This is about pairing that system with some serious self-control.
Let's be crystal clear about something. This is not a risk-free strategy, not at all. You're still facing major risks. You've got that lockup selling pressure we talked about. You've got companies with very short track records. You've got the risk of just bad market timing or management being way too optimistic with their forecasts. Acknowledging these risks head-on is the first rule of discipline.
And to manage that risk, here's a hard and fast rule from the pro's playbook. Never, ever have more than 15% of your portfolio concentrated in IPOs from any one single sector. That one simple rule acts as a critical safety net. It stops you from getting wiped out if one particular industry suddenly takes a nosedive. So when you boil it all down, success in the IPO world isn't about some single magic trick. It's about this powerful combination of doing your homework on the company, getting the timing right, playing the application game smartly, and wrapping the entire thing in strict, non-negotiable risk management. It's the whole package.
So we'll leave you with this one question. We've laid out the entire system for you, the professional's game plan for turning an IPO from a pure gamble into a calculated opportunity. The system is clear. The only question left is your discipline strong enough to actually follow it? Thanks for watching The Explainer.